Keelan, I know you've got some good news, and I have some, I don't know, it's going to be up to your determination on how this news is, but I thought I would bring in and talk a little bit about interest rates today. They've dropped to a 14th-month low, and Chief Deputy Economist Leonard Clifford from Freddie Mac shared that we've had the largest rate drop in over a decade, December 4th, 2008. So It's crazy. Now, just to know, this doesn't mean that the interest rates are the lowest that they have been. The lowest the interest rates hit was 3.25%, and they're averaging maybe around 4.32% right now. But the Feds announced that they did not lower the mortgage rates, but the Feds are slowing to the global economy is slowing and wants to keep the cost of money low to help make it easier for consumers to borrow money on short-term loans. Remember, again, the Feds only affect the short-term loans, so that would be your credit cards, your car payments, things like that, not mortgage interest rates. So the Fed stated that they are going to change their course after predicting a few rate hikes for 2019, but now stating that they're going to leave rates alone. Again, the short-term rates, not to confuse it with the long-term rates, which are mortgage rates, which are based on the Fannie Mae 30-year bond. Now, the Fed's role is to stabilize prices and employment. Their role is to manage inflation and maintain a balanced market. The current Fed rate right now is at 5.5%, with the last increase was December 20th. They increased rates 4 times in 2018 in an attempt to slow down the economy. So it's really interesting when you kind of watch what's happening with the Feds, because again, I've shared what their role is, but they can't predict what's going to happen. And if you notice, when the Feds are giving you a sneak peek behind the conversations of what they're anticipating doing, that's because they're actually testing the consumer confidence to see what's going to happen. And so if they're going to increase the interest rates, they'll see how the markets are going to affect on that. And if it has too much of an impact, then they're not going to move forward with that change. Now, what's happened with mortgage interest rates is when there is a lack of consumer confidence, or consumer confidence is down, investors are pulling out of the stock market and they're going into the bond market. So bonds are trading higher, including the Fannie Mae 30-year bond. And if it's trading higher, mortgage rates are going down. That's why you normally see the stock market and the bond market working opposite of each other. Now, NAR announced that existing home sales jumped 12% in February, 4 times higher than the predicted at 3.2%. Now, the reason for this is lower rates, more housing inventory, raising income, and higher consumer confidence. So which is it? Is the economy slowing and having lower consumer confidence, or is the economy getting better with higher consumer confidence? Well, Forbes says that we have a 30% chance of a recession in 2019 and 2020, and the Fed's reaction trying to balance consumer confidence. So I don't believe that we're going to hit a recession, but I do believe that we're going to see a slowdown in the market, and we'll have to see what happens in the upcoming couple years.
It sounds like a lot of confusion, Tina. Holy smokes.
There is a lot of confusion.
And it goes back to I
had to keep this to a minute or two, right?
Yeah, no, and it comes back to that, if we had a crystal ball, we'd all be drinking Mai Tais on a beach somewhere.
Yeah.
And you always talk about...
We should bring Mai Tais into studio. Dang it. What's up with this bottle of water?
Fail. Well, I was going to talk about, it actually teased right into what I was going to talk about, and I was reading about, and I said something about this before, but I was reading about Amazon securing the lease in Bellevue, and they're backing out of Seattle, and REI is coming over here, all this crazy growth. And I was reading up on the inverse yield curve is what they call it. And since 1982, when they see this, it's possible there's a recession. But I kind of feel like we're in this bubble over here. We have this homeless thing that's come up in Seattle, that head tax thing last year. I think that played its toll, and people, big business is they're moving over here for a reason. Obviously something upset them. So they're coming to the east side. East side's blowing up. And so it's going to be really interesting in these next couple years.
You live in Seattle. I live on the east side.
Oh, I'm coming to the east side. I think that's where to go. Catch the wave, and the homeless issue is pretty crazy over there. I mean, you see it everywhere.
Take a look at Seattle Dying video. It's pretty crazy to see what's happening behind the scenes with that.
It is. And I mean, if you've lived here, I've lived here my whole life. I've saw with my own eyes. You see these...
Seattle's not dying, by the way.
It's not dying. It's not dying. It's going to grow. I think it's going to be the next San Francisco. But I'm hoping we can make some changes with those that represent us. And because there's a lot of people that are unhappy, including the big businesses, which is going to severely affect the economy on the east side with Amazon. So if you're looking to invest or buy, I mean, it's looking pretty sweet over here.
And the
on
rates
east
are
side.
low.
And the
Take
rates are
advantage of it,
low.
yeah.
Hop on the bus on the east side. It's
Yeah.
looking pretty good.
And we do mortgages.
We do. So
Yeah.
you better call us.
Call us.
Yeah.
We can help you out and hook you up.
We can tell you all about it.
Yes. Well, great conversation for Money Chat, Keelan. And coming up next in the Money Hour, learn to market without money. Aaron Alexander with Finally Social, right here at 11:50 a.m. KKNW after the short break.